Hello, my dear friends. Once again, welcome to my YouTube channel. And today you might have observed that I have given a name and logo to my YouTube channel. I hope you liked it. Today we are going to discuss types of financial markets because in the previous session we talked about introduction. We gave just introduction of financial markets. How they work and why they are important, what are the key players in this financial market or different financial markets. So today we will talk about types of financial markets. First and foremost is stock market, which can be further divided into two different types, that is primary and secondary market, and I am going to discuss that in the coming slides. And then we have bond markets, we have commodities market or commodity market, and then we have foreign exchange market, and we have derivatives market. So some of you might get confused that in some books there is a different type of classification given for these financial markets. So please don't get confused. That is also fine, and this is also fine. This is one way of classifying the financial markets. Now, first, that is stock market. So before I get into the details of stock market, let me tell you there are two subcategories of this stock market or this share market. One is called as primary market or IPO market. Another is called as secondary market or the capital market. Now, what is the difference between the two? When a company goes for IPO, that means when a company issues its shares first time to the public, we call it as IPO, initial public offering. So it happens through primary market. So the place or the market where it happens is called as primary market. And once these shares are purchased or subscribed by the people and different investors or companies, then these shares are moved to the secondary market, like your normal BSE, NSE, right? These are two examples. So we call that as secondary market. Okay. Now, what is this stock market? Markets where shares of publicly traded companies are bought and sold. So you, me, or anybody who has a demat account can easily buy and sell shares of these companies which are listed on the stock exchange. And it allows companies to raise capital and investors to earn returns, right? So how does company raise funds through this capital market? Let me explain that first of all. Imagine that you have a company, a private limited company, which is earning profits for the last 3-4 years, but now you have a very good project that you want to expand, but you need a very huge amount of capital for that. Now, a bank will not only give you that much amount, right? A bank may not be feasible for you as well as for the bank also to give you the whole amount. And even it may not be good for your business also to invest only your own funds. So instead, what you can do is you can go to the capital market, you can issue your shares in the primary market, and then you can get amount whatever is required for your particular project. Okay, that is how a company raises capital from the stock market. And obviously for investors it gives a return. When I buy shares of ABC Limited, just an example, ABC Limited, and I hold it for some period of time, there are two types of gains which I can get. This is general. Whenever you invest in stock market, there are two types of returns you can expect. One is dividend, another is capital appreciation. Now, what is dividend and what is capital appreciation? Dividend is that part of profits which is divided among shareholders in proportion of their shares. Okay, now for that obviously a company has to make profit. If it does not make profit, they may not pay you any dividend, right? And it is not necessary for a company also to pay dividend. That is a secondary thing. Another return which you can expect when you invest in stocks is capital appreciation. Imagine that you are buying a share of ABC Limited today for 100 rupees, and if you hold it for some time, maybe 6 months or 1 year or 2 years, its price will go up. if you have purchased it for 100 rupees today, it may be selling in the market for 150 rupees after 6 months or after 1 year. So when you sell it, you get a return of 50 rupees, right? That is capital appreciation. Now, another type of market is bond market. Now, markets for buying and selling debt securities issued by governments, municipalities, and corporations. So, this is a market where bonds are bought and sold. Now, what is a bond? First and foremost thing, you should understand that. Now, bond is a debt instrument. Now, what do you mean by debt? Debt means, it is a kind of loan which has fixed rate of interest written on it, which is not the case in securities or equity. So in case of bond, there is a fixed percentage of return which you can expect. For example, I buy a bond whose face value is 1000 rupees and its rate of interest or coupon is 7%. So compulsorily a company or government has to pay me 7% interest every year if it is a yearly bond, right? So we call them as debt instruments. Now, why does government or municipality or MNC, issue these bonds? First, the objective is similar. Government might have a very good project and they needed funds for that. For example, National Highways Authority of India have previously issued bonds. Now, why do they issue those bonds? Because they needed funds to construct national highway, the roads, right? So when they issue bonds, they get funds for that particular project and they construct roads, right? Similarly, municipalities also issue bonds, right, for carrying out some developmental works. And again, multinational companies, they also issue bonds for their particular developmental work. Now, it provides a source of financing for issuer. Obviously, when a company or a municipality or a government, they issue bonds, it provides a source of financing for them and fixed income for the investors. When I buy a bond, it gives me fixed return. I'm an investor. When I buy a bond, I'm an investor. So I get fixed return from investing into these bonds, whether they are issued by governments, municipalities, or corporations. Another type of market is commodity market. Markets for trading raw materials or primary products such as oil, gold, and agricultural products like dals. All those are traded actually on commodity market. So in India, we call it market for commodity exchange. It's a very huge market, and it works on different types of contracts. Like one is spot market, which is for immediate delivery, and another is future market, which is for future delivery, right? So we will talk more about this when we go to that particular segment of commodities market, right? Another type of financial market is foreign exchange market. Markets for buying and selling different currencies. So this is a market where you can buy and sell foreign currencies. Now, why do you need to buy and sell foreign currencies? Because if you are an exporter, importer, obviously you will need foreign currencies, or if you're traveling somewhere abroad, you need foreign currency. So that is where foreign exchange market helps you, right? So this is one of the largest markets and most liquid market globally. It is essential for international trade and investment. So this is largest market in terms of value, right? Because only currencies are traded on it, right? And it is the most liquid market. I hope you remember what is liquid. Yesterday I was talking about liquidity, right? So this is one of the most liquid markets globally. Another type of market is the derivatives market. Market for financial contracts whose value is derived from underlying asset. Now, before I explain this, you have to first understand what is a derivative. Okay, now what is a derivative? Derivative is a financial contract whose value is derived from the underlying asset. Now, underlying asset can be shared it can be a commodity, can be anything, right? So this is the market where these derivatives are bought and sold. So market for financial contracts whose value is derived from the underlying asset, as the name itself says, derived. Now it does not have any value if there is no asset underlying, right? Its value is derived from the underlying asset, and underlying asset can be anything. It can be a share, it can be a commodity. Now most common derivatives are options, futures, swaps, right? Even forwards, right? So it allows for risk management, speculation, and leveraging investments. Now this helps to mitigate the risk. This helps to manage the risk. Now how does it help? How does derivatives help us to manage the risk? Imagine that you are a vegetable trader, okay, and you are not certain about the prices and supply. So what would you do is you'll go to the farmers and you will enter into a contract asking them, you supply me X amount of vegetables at Y rate. So today you are fixing the price and the quantity, and the delivery is going to happen on a future date, maybe 1 month or 2 months after the contract. So you basically are saving yourself, you are mitigating the risk. What is the risk? That if you don't get this supply, obviously you will be in losses. Now I gave example of vegetables, it can be anything, okay? So this is how we actually manage risk with the help of derivatives. It can be speculation. Now what is speculation? So you buy something in anticipation of selling it at a higher price, right? And then leveraging your investments. So derivatives market, it is the finance market where financial contracts whose value is derived from the underlying asset. As I said, underlying asset can be anything, right? So that's it for today. Thank you once again, and stay tuned to my channel for more on this particular course.